I've been encouraging you to think about the potential appropriateness of investment bonds once you have taken account of and maximized the use of more tax efficient investments, pension arrangements, ISAs, where appropriate, VCT, EIS, unwrapped investments in collectives where you can use the dividend allowance and the CGT exemption. For money beyond that, where you have those clients who have money to invest beyond those so-called tax no-brainers, then they have choice in relation to a general investment. They have choice as to whether to continue down the unwrapped path, investing in collectives, or to choose an investment bond, UK or international. Either of those bonds give you tax shelter along the investment term because there is no tax payable by the individual. That's particularly valuable in relation to dividend income, which would otherwise bear that dividend tax rate above the £2,000 dividend allowance. And that tax rate, of course, is going up by 1.25% for all tax bands after the 5th of April 2022. So we're looking at some quite serious tax rates on dividends for basic rate taxpayers, higher rate taxpayers, and additional rate taxpayers. And that's why consideration of the investment bond is worth taking seriously, especially if you also are going to be using your annual CGT exemption with other investments. Okay, so once you've used your dividend allowance and your CGT exemption, the tax sheltering of the investment bond looks particularly attractive. But what about when the time comes to taking money out of the investment bond? Well, international and UK investment bonds is kind of taxed on broadly the same platform, as it were. That's tax platform legislation, in that you can take out by a horizontal withdrawal, as it were, across all of the segments. You could take out a part withdrawal. And as long as the amount that you take out doesn't exceed your accumulated 5% of the original investment allowances, then you won't pay any tax at that time. But it's really tax deferment, because that withdrawal that hasn't been taxed at that point will be taken into account, added back to the calculation when you finally encash the segments or policies from which you have taken a withdrawal. The other way is to take money out of the investment bond by cashing in a whole policy or a series of whole individual small policies. Most bonds these days, you'll know, are written as a number of smaller policies to give you flexibility on how you take the money out. The great thing about that is when you make an encashment, that's the end of it. It's not tax deferment. You determine whether there's a gain or not at that point. And the key point here is, in determining whether there is a gain, is top slicing relief. Because for higher rates of tax purposes, you take the gain, divide it. This is a very shorthand description of how top slicing works. It's a much better, more full description in Techlink. But you take the full gain, divide it by the number of years that the whole policy years the bond has been in force, and it's only that smaller amount that you add to your other taxable income to determine whether there is a liability to higher rates of tax. And that's really important, especially for UK bonds, because if there is no liability to higher rates of tax, because that small gain, that segment of that top sliced gain, if that doesn't take your other income, when added to your other income above the higher rate threshold, there is no tax whatsoever. There's only tax to the extent that that top slice exceeds the higher rate tax threshold, in which case the liability that it generates is then multiplied back by the number of years the policy has been enforced. But if it falls below that threshold, there is no higher rate tax payable, and you get a full basic rate credit. That's the key thing. Whilst the life company, the UK life company, will have paid a lower rate than 20% on the underlying fund's composite rate, because dividends are completely tax-free, and a lower rate is usually assumed for tax on the capital gains inside the life fund, you get a full basic rate credit. So if that top slice doesn't push you above the threshold, and this has always been the case for many, many, many years, which is why it's so encouraging and reassuring, then you will have no liability on your encashed gains. So if you've had the bond in force for a long, long while, then the benefit of top slicing means you could take out significant sums from your investment bond legitimately, completely tax-free. It's an international bond. All other things being equal, the underlying value of the bond will be greater at the point you want to consider taking money from it. However, there is no basic rate credit. that top slicing relief only works to determine the extent of, or whether there is any higher rate liability. There will always be a basic rate liability to the extent you haven't got your personal allowance and your personal savings allowance and your 0% savings band to use, which will all, or could all, be very useful in the decumulation, taking money out of international bonds, which is right for any particular client. Both give you the tax sheltering, but it's about looking ahead to what your position is likely to be when you take money from the investment bond as to whether an international bond or a UK bond is better for you. And that's where having an advisor who knows their stuff is so important. And that's where maybe for the advisor, having access to Techlink and all of the great examples within it is also very, very important.